Next guest calls this, quote, strong omen for the market. Sees stocks rallying 20% this year. Joining me now right here, Post 9, CNBC contributor Tom Lee of Fundstrat Global Advisors. Happy New Year. It's good to see you. Welcome back.
Great to see you, Scott.
So you were admittedly too bullish last year.
Yes.
You are, in a sense, doubling down on that. 20%? How?
Yes. Last year was a year where inflation shocked the markets in the first half. It's come off the boil since October, very soft. I mean, if December comes in the way we think, it's probably 2.6 annualized inflation now. And wages are coming off the boil, right? If we look at the employment report Friday, they're growing at 3.7, which is where they were before the pandemic. So the third thing that we think needs to happen is volatility needs to come down in the VIX. The bond market volatility is below its 200-day. If that happened in the VIX, we'd be at 17. And since 1950, following a negative year, if the VIX is lower on average than the prior year, we're up an average of 22%. So I think we're set up for a 20% year. Even with the Fed speak, you know, if it's not Kashkari, it's Esther George. If it's not Esther George, it's Bostic. Just to make, sure Bostic got his message across. He spoke late last week. He spoke again before the show today. I mean, these guys are talking, and women are talking tough. Yes, they're talking tough because they want financial conditions to stay tight. That's dollar, stocks, bonds. Everything's kind of easing, so they're probably a little worried, and they want to be sure inflation is, in fact, dead. But I think one of the changes, especially since October, is that inflation's been undershooting. This Thursday will be very telling, but if CPI comes in at 0.2 core, below consensus again, that means the Fed's original projection of 4.8 on the PCE is 60 basis points too high, translating that over. And that means inflation is undershooting by a huge margin. The bond market is going to push the Fed to say February might be the last hike, and then after that is cuts.
I mean, but the Fed members themselves are not, drinking what the bond market's serving up, right? They keep talking as if they're, as I used the word with Leisman a little while ago, hell-bent on getting to that plus 5%, however much over 5% we can argue about, and then staying there for a while.
Yeah, I think that's because part of the Fed model is they're using a Phillips curve. And at the moment, they're focused on this services number, ex-housing, which has been inflationary, and their view is that it's driven by wages. But what is sort of not being captured at the moment is the goods have dropped so much, and wage inflation slowing, and housing, especially this week, looks like it's actually come off sharply, that the trajectory for core could be, we could be sort of annualizing close to 1% in the first half, and that's far below what the Fed. I think at that point, the Fed would have to sort of rethink its reaction function.
So what happens if they, I'll grant you, let's say they pause, right, but they don't cut? How much do you need a cut to get your 20%?
I don't even think the Fed would even have to cut, because once they pause, which is now, the Fed went from 5.1's the terminal rate to we're pausing at 4.75, it raises the bar for them to start hiking again. So I think that the bond market would interpret that as the start of a cutting cycle. I think rates would come down. Of course, this will worry the Fed. That's why we're hearing tough talk. But if inflation data comes in soft, I think everyone's going to be on the same page.
So a pause alone is enough for a huge rally in stocks?
Yes. Yeah, in fact, I know folks talk about earnings could be down this year, which I think is a possibility, but...
Well, is it a probability or a possibility?
I think it's only a possibility, because the dollar falling is a tailwind for earnings. And but if earnings are down, since 1950, it has not been an important factor for if stocks go up or down. So it's volatility, the VIX is a much more influential factor.
Do you think the market's going to overlook the fact if earnings come in even lower than where projections have re-rated them to already? Markets going to overlook that?
Yeah. In fact, I think that's, we can look at it even just now. Tesla missed on delivery numbers. It's at 120 now. I mean, I think stocks are already showing you that you could have bad news, but if it's priced in.
Well, I mean, yeah, we're going to use Tesla as the litmus test. I mean, that stock's already gotten from a multiple of 80-something, all the way down to 20.
That's kind of why it's interesting. If you look at what's correlated to financial conditions easing, it's tech, discretionary, and industrials. These have been doing well. They're kind of telling us financial conditions will ease. But also, these stocks shouldn't go up if earnings are, I mean, these should be the ones getting hit by earnings, and they're going up.
What about tech? It remains the biggest, I don't even know if I should say biggest question mark, because it seems like the questions have been answered. The stocks were overvalued. Even the mega cap stocks that deserve to have a premium valuation don't necessarily deserve the premium that they even still have now, which has been compressed as well.
That's right. Tech's been a darling. It was over-owned. They got expensive. Now people think that they're going to derate forever, but we know that if the market is bottomed in October, tech has always led off a bottom. Tech is also how you cure inflation, because that's how you reduce wage pressures. And if the multiples have come in and financial conditions ease and rates fall, then multiples should go up. So tech has tailwinds this year that didn't exist last year.
Do you think the worst is over for, and let's separate the baskets of tech. Massive multiple once to FANGs, the mega caps, which, most of them, I think we would suggest their multiples weren't nearly as egregious as some of the others. Do you think the mega caps, the Apples, the Microsofts, et cetera, have they corrected enough?
Yes, I do, because I think that their shareholder base includes a lot of people who have huge capital gains, aren't going to sell because of a miss, but a lot of those who had to get out because of performance issues have sold. So I think tech can get new ownership, and that's what's going to help them. On the mega cap, on the hyper growth stocks, if rates fall, it's going to help them. So I think that they can bounce, but they're not the ones that make this a good year for stocks. What's going to make this a good year for stocks is industrials, discretionary tech. And I think that it's going to feel better as we go through this year if inflation continues to undershoot.
What's your most favorite sector right now?
Well, I think FANG might be the easiest buy, just because nobody really thinks it can do well. And of course, if FANG rallies, that's going to almost drive the 20% gains.
Easier than, say, a financials or a healthcare or an energy where, a lot of the smart money has been going?
Energy, we've liked it since 2020.
Alleged. Alleged smart money.
Yeah, and, I think it's going to re-rate. But the challenge is that it's still got a geopolitical element to it. Healthcare, I think, is a good GARPy group, but it's not something that can be up 50%. FANG could be up 50% this year.
So you're thinking that 50%?
Possibly, yeah.
50.
Yeah.
So the Nasdaq's going to have that great. So if the S&P is going to be up 20%, what's the Nasdaq going to be up?
It's well over 20. Scott, I just say that the first 5 days is a pretty indicative of how markets go for the year. In fact, of all the instances where you had a negative prior year, and then you're up the first 5 days, okay? That's 85% of the outcomes had positive gains for the rest of the year, averaging 20%. The only two exceptions was 1970 and 02. So maybe if you think this is 02 when we have a lot of trouble ahead, but if it's not 02, then you have an 85% probability it's a 20% year.
Well, you set the bar this high at the beginning of the year, Tom. There's little wiggle room now. You got to get there.
All right, so I'll just have to come back on December 31.
You'll be back many times between now and then, I hope. Thank you for being here.
Yeah, thanks, Scott.
All right, that's Fundstrat's Tom Lee with